Odin has $50,000 in income and $10,000 in deductions. Odin will only be taxed as though he made $40,000. While this looks like Odin is being taxed $10,000 less, that isn't the case. Deductions are calculated by multiplying the deduction amount by the individual's marginal tax bracket rate. Let's say Odin's tax rate for his tax bracket is 25%. Odin would multiply his tax savings of $10,000, which is the amount of deductions he had, by his tax rate of 25%, totaling of $2,500 savings in taxes owed to the government. In contrast, tax credit amounts subtract directly from the taxes a person owes dollar for dollar, rather than lowering a person's taxable income like a deduction. If a tax credit is $200, the individual will save the full $200 in taxes. There are different types of tax credits: refundable, non-refundable, and partially refundable. Refundable tax credits are paid out in full, meaning the taxpayer is entitled to the full credit amount and will be paid a refund if they do not have a tax liability. For example, Sherry owes the government $1,000 in taxes this year, but finds out she met the criteria for a tax credit of $2,500. If the tax credit were refundable, $1,000 of Sherry's tax credit would be used to cover her tax liability, and the remaining $1,500 would be paid out to Sherry. Some tax credits are only partially refundable. The tax credit would be used to reduce the taxpayer's liability. Suppose their tax liability is reduced to $0 before the entire tax credit is used. The remaining balance becomes a refundable credit of 40% of the remaining credit balance, or $1,000, whichever is less. If Sherry's $2,500 tax credit were partially refundable, it would be used to pay off her $1,000 tax liability, leaving the remaining $1,500 of the tax credit. How much of the remaining tax credit would Sherry receive? She would receive 40% of the remaining tax credit balance, $600, because $600 is less than $1,000. Remember, the refundable credit is the lesser of 40% of the remaining balance, or $1,000.